Tom, market's going crazy. Gold down 4% in the last hour. Silver 7% on the day. Bitcoin's down. What's going on?
It just looks like risk is rolling over, to be honest, and you're seeing yields be bid. So you're seeing, which is basically bonds be bid, yields come down. So that's it's a flight to safety. Even though gold has come down, silver has come down drastically. You're seeing I say this is the first time in a long while where we're seeing like a real flight to safety that isn't, I suppose, not gold led, but sort of a risk away or a de-risking move away from risk assets and into something else that is arguably somewhat speculative as well, which is gold and other like precious metals. But now it's not. You're just seeing all risk come down and risk assets come down, and the money basically flood into bonds, and it's government bonds, which is why the yields are down substantially today.
Okay, interesting. Why though? Why is this happening? Why is risk happening so fast?
I think there's just a bad feeling at the moment in the market in general, even though the indexes are high. So this is like crypto aside, forget that for now. The stock indexes are still quite high, but they look to be in sort of distribution mode where they've sort of gone up like this, and now they're sort of rounding off and topping off as if they're going to roll over slightly. I think there's big fears over the AI capex, and in terms of why these companies just continuing to like throw money to do build outs in this big AI race, and I think investors now starting to question whether that capital expenditure, that spend, is actually worthwhile, warranted, worthwhile. Is it a waste of money, etc.? Has it all gone too far? So I think that's where the sort of problem lies, and I think people say, I'm just going to de-risk a little bit from here. It seems to me like the market, again, crypto aside, we're talking the indexes. It seems like they've gone up like this. They're now topping out like that, and now they just need a catalyst, some form of catalyst or excuse to tip over. So I think that's sort of roughly where we're at. I think crypto sniffed this out before, because you get the de-risking in crypto, like software stocks are down a chunk. The ticker is IGV ETF, if anyone is interested. That's sort of very highly correlated to crypto. But yeah, that's my general feeling. Like rate cuts have been pushed out very slightly now following the jobs data, even though it's how trusted it actually is hard to really know, especially when you had a creep up in jobless claims today. Again, jobless claims is a little bit volatile, but and it's a week on week measure, so it's not something you can really just because you get one bad week does not mean that's telling going forward. For instance, obviously, if it becomes a trend, different story. So it's just a lot of that really. You're seeing, I think it's mostly the AI side for the stock indexes. Crypto has sniffed out the liquidity aspect in terms of, even though you see all these people saying M2 is going higher, blah, 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 there's this big liquidity impulse. There isn't really at the moment. There's a liquidity impulse on the Chinese side, but again, that money hasn't flooded into crypto, it's flooded into precious metals, gold, etc., which is why that sector has done well. That essentially is where I think we're at for everything. I think the monetary policy being pushed out, interest rate cuts being pushed out, has not helped our cause, crypto's cause.
Okay, the fears surrounding AI, are the markets, is it warranted? Are they justified in their feelings? Or is this just the market getting, just running on emotion?
It's a bit of both, but it is also somewhat warranted as well. Just because something is tech, for instance, was very revolutionary, but you had a big boom in the late 90s into 2001. I think Amazon's share price topped in 2000 or 2001. Can't remember which one, not remember, but from my research, which year that was in. It took 10 years for Amazon to re-reach that all-time high again. Now, Amazon was a very successful business throughout those 10 years, but so what I'm trying to say is things can get overblown in the short term. They can be, overvalued, too expensive in the short term. And I think that might be where the AI setup is at the moment. And because the AI sector, or AI companies, the companies related to the AI big capex spend, because they're such a large weighting in the index now. If there is a de-risking in that sector, or a pullback in that sector in terms of investors, just de-risking very slightly, that brings the whole index down, and it sort of brings the sort of general market down in terms of other stocks and shares, because you just have this de-risking almost across the board. And it just seems that there's areas that are. I think we had home sales out today, which was their lowest reading, lowest month-on-month reading since early 2022, I believe, or late 2022. I can't remember which one it was. But in terms of home sales in the US, so there's a housing, or the property market in America has been in a recession for a few years. That market needs rates lower for people to unlock equity in the house, get money back out, start spending, etc. And to be honest, it doesn't look like that's actually going to come, even with rate cuts. If you get rate cuts, you're going to get the front end US 2-year, etc., to come lower, but the 30-year yield is probably going to stay elevated because of the fiscal situation in America. Not because it's diabolical, because obviously the tariffs, etc., have helped towards that fiscal balance. But ultimately, if the 10, 20, 30-year bond yield stay elevated, people are not going to be able to get equity out of their house and spend money, and you're just going to see this constant or consistent tightening in the housing market. And I think that eventually spills over to other areas, even though we're not seeing it in the labour market or anything like that yet. But we have seen retail sales sort of begin to slow down as well. So I think it all takes time. These things do take time. Just because you see the cracks, they don't take 1 or 2 months. They can usually take like 2 to 3 quarters to really play out. So I think we're somewhere early in that. I think if you have some cash on the side, especially, if you can do a decent weighting towards some cash to go and pick things up over the coming months. And I'm not talking sort of 10 months, 12 months. I'm talking like 2. I think it's going to be very 1 to 3 months on that short end. And then I think you get Kevin Warsh coming in. That helps stimulate the markets in terms of, I think he'll just try to push through rate cuts. You might get people siding more with Waller, who dissented due to the labour market weakness, or because he's seeing weakness in the labour market. For instance, the hiring rate is very low. Just because you're not seeing outright layoffs does not mean people are getting hired. Just doesn't mean that there's lots of hirings going on. And all of this is going towards Trump's sort of declining rates. So I think he needs to do something drastic to essentially get his polling back to a better level so that he can win these midterms. I think he's very fearful that he'll be impeached if he loses the midterms. So I think it's all to play for, and a lot can happen this year. And I think it'll be something similar to 2025, where you can get a big move down to then rebound again.
Yeah, no, very, very interesting. What could Trump possibly do to spin the narrative?
I think he's got a very big uphill battle, to be honest, because I think he needs to unlock housing in terms of he needs to reinvigorate the housing market. And I think that's just very difficult to do, because again, even if you cut rates, which historically would have brought interest rates down, i.e. people borrowing for their mortgage and whatnot, I'm not sure that's going to happen this time, because even though you might bring interest rates down, that might bring the front end of the curve down, i.e. the 1 year, 2 year. But I think because of the fiscal situation, the long end bond will stay high. So it's going to be what you call curve steepening. So I think that's the key for Trump, because he's always said, or he said recently, to value Main Street over Wall Street. And just because, and I think the economy can actually do well this year, but just because you have a good economy does not mean you have a good financial markets. Usually you see, when the economy is on the floor and they really stimulate, the economy takes years to get out of the doldrums, where markets get that liquidity stimulus and the markets perform very, very well. We might now be on the part of that cycle where the economy reaccelerates, but financial markets slow down or pull back. So I think that's somewhere where we're at with this.
Yeah, that makes sense. I believe it was yesterday where we got the labor market data, non-farm payrolls, etc. And the data came in healthier than expected, which, of course, the big narrative spinning at the time immediately was good for the economy, bad for crypto, because it pushes rate cuts out further. Yeah. So it's kind of what you mentioned there. It's what's good for the economy is not necessarily good for the markets, and vice versa. And we almost want to see the economy in a bit of danger because that's where the government is, well, the Fed's justified in cutting rates. So as of right now, you mentioned, I think, retail sales going down. We've seen the labor market show strength, not weakness yesterday. How does all of this work? Because yes, the gold is down, Bitcoin's down, everything's going down. You mentioned bond yields going up. But what's it like for the average guy right now in America? Is he richer?
Struggle.
Is he poor? Struggling
No,
really bad?
yeah. Well, the average is struggling. The lower income is struggling. The higher income is performing the best they performed because they're the ones that own the assets. They're getting paid this higher interest rate, or it used to be a year or so ago, it was a higher rate. And the lower incomes just can't keep up with that benchmark. The interest rate, you're seeing what's the 30-year for now, 4.8 or something. 4.77. So that's what the 30-year rate is. So what's your mortgage rate? 6%, 7%, etc. I spoke to a family friend of mine a few weeks ago who's literally in this situation where he wants rates to come down so he can sell his house or remortgage his house. But at the
Mhm.
moment, they're not being able to lock in the value that they want for a remortgage because there's not transactions going on in the housing market. There are obviously, but it's just very, very low. So I think the average person over there is struggling, especially with the cost of living having gone up substantially over the last, since COVID. Don't get me wrong, the cost of living is not increasing that much now. They say inflation is 2.6% or whatever. That's great. That's not a lot. The problem is prices from COVID 2020 to now. Some shopping bills have doubled and stuff like that. So the normal and that person's wage from 2020 to today has not doubled. So really, they're still in this that bandwidth. They've still lost against the increase in prices. Their wage is not increased by the same proportion or the same percent. So I think the normal person is really struggling, and it's the wealthy that are still doing well. So you're just seeing this wealth distribution become smaller and smaller again, and the wealthier get wealthier and wealthier, whilst the poorer get poorer and poorer, or more poor. So it's difficult and they need to bring that balance back. And how they're going to do it, it's difficult because you need to bring rates down to make the cost of borrowing money cheaper. But it's no good for the normal man if their credit card bill is still at the same elevated percent because the 30-year yield and 20-year yield is still very high because of the fiscal
Yeah.
situation. So it's just very difficult. I think Warsh will come in and try to bring the Fed balance sheet down so they can do something about the debt that they owe. But it's going to take a long time for him. This is not something that's a 1 or 2 year job. That's something that's like a 4 to 8 year job. And even then, it's a very, very slow process. So I think the like Chinese, etc., are now, those economies do better. Like even places like the UAE, etc., will grow at better rates now. Yeah, they have the room to grow, etc., compared to the US, but they're run by not dictators, but the equivalent or whatever. China is a dictator, I suppose. But the good thing with that, again, this is a bit of a personal opinion. Maybe I'll get pounded for this, but I think with those leaders, they're not going to be voted out in 2 years' time. So they can go and put a 10-year plan together where you look at the UK, for instance, like 1 minute it's Keir Starmer, then it was it's just every administration is just getting like kicked in the teeth, moved on. It's not been good enough. Don't get me wrong, all the policies are crap. They're all terrible. But, and I think Trump is going to I think the Trump policies are quite good. I just think it's something that is a 10-year plan rather than a 2-year plan. And he's going to get voted out in November, essentially, or he's going to lose these midterms, and then he's not going to have much power.
Yeah, that's a huge problem in a lot of these societies that you just don't have enough time to get anything to work, and then you're left in a situation where the next party takes over and they undo everything that you just did, and it
Yeah,
seems to be a cycle every 4 to 8 years. It just doesn't work, and that's probably why China's done so well so long. It's easy, for us to criticize them as a country for the way they operate, but it's working. The numbers don't lie. As far as the levers at I guess the government and the Fed's disposal. We spoke about Trump, what they could do. Um, we mentioned like the Fed with interest rates. What about tariffs? He's still throwing them out all over the place, very flip floppy. This seems like something that can affect the average American too. especially if you run a small business?
So I don't decide. Again, this is hard to know because it's not something that you're gonna, unless you're the actual consumer over there. And again, unless you're speaking to actual consumers over there, you're not really going to know. But it seems to be, when you look at the data, and again, you're not on the street, so you'd have to really, this would be a job for canvassing on the street to really find out. But it seems to be that it's the importer it's the importer that's paying the charge. They're not passing the charge onto the consumer. The consumers are not picking up that tariff bill at this moment in time. So
Okay.
so I don't think that price increase is being passed on to consumers. So they've not really been hit by it as of yet. Now, the tariffs are actually good for America at the moment because it means they have this huge revenue coming into the country each year, or into that country's balance sheet each year. So then all of a sudden you can look at, okay, they're printing this amount of money, or they're trying to sell this amount of debt, but they have revenue or income of this amount. Okay, that takes. So if you saw the tariffs come off, for instance, the Supreme Court just struck them down, and they're not. Trump would get them on in another way, but essentially, I think yields would shoot much higher because all of a sudden, investors would demand a lot more term premium to go and hold this debt, because you now have a country that's just printing a load of money but not having any of that offset with this big income that they're now getting from tariffs. So if you pulled away that big income, you would then say, Christ, this fiscal balance is going to get really out of whack here. Why on earth would I now go and buy your debt? For instance, it was it Google that did the 100-year debt the other day? I think it was 2 days ago. I think it was Google that did 100-year debt, and it was like heavily oversubscribed. So people would rather go and buy Google's note over a 10-year bond from the
Oh,
US.
wow.
So it's yeah, I think tariffs I don't think are huge for now. I think we've seen that sort of impact. I think you're still seeing the impact from the inflation, but it's coming towards its end now. I think that sort of pass through has happened now.
Okay, that makes sense. And that's pretty much what does Trump have to do to spin things around. Kevin Warsh, I've seen people say he was a bit of a paradoxical choice because he's been relatively hawkish throughout his history, but he's been pulled in here because the expectation is for him to be dovish. Tell us a little bit more about Kevin Warsh.
So he served on the Fed before, so he knows the institution quite well. He I think Trump even said the other day he should have. So he was Trump's runner-up to Powell in 2018. I think I need to check that, but I think it was 2018 when Powell came in as Fed chair, and Walsh was the runner-up. So like how Hassett or Rick Reeder or Waller was now as the runner-up. Walsh was the runner-up to Powell in 2018. I think what they're going to go for is they're going to go for some like an accord between the Treasury and the Fed, which is going to be to lower interest. So they're going to be dovish on rates and hawkish on the balance sheet, which is long term. It's good for Main Street. It's not particularly great for markets if they can bring the balance sheet down a chunk, but I don't think they'll be able to actually do that. So really, they're just going to keep bringing rates down. So I think this year you can see some like positive impulse because of that, because they're not going to get to balance sheet reduction in this next 6 months, next year, or whatever. But he's the way to view it is he's dovish rates, hawkish balance sheet. That's the essentially way to view it, which is a good for Main Street, not so good for markets. But again, this is a market that needs to move away from liquidity driven, and it needs to move back towards value proposition, for instance. So that's where I think we are. But again, they always end up in problems, and they have to really sort of print their way out of it. Trump is coming up to be re-elected no, Trump is not. The midterms are happening.
Yeah.
Trump can't lose his midterms. They're happening in November. He's going to probably try to juice it to stay in. Otherwise, he's out and he gets a bad reputation, etc., etc. So they always do the same thing. They always talk the right thing to actually do. They never end up doing it. They just print because that's their only option. Otherwise, they risk losing the next election, which is why elections just don't.
Yeah.
For markets and economies, elections don't work.
Yeah, wow. It really is as simple as that, right? The way you put it, it's Main Street and Wall Street not necessarily aligned. What's good for the markets isn't necessarily good for the average guy. Trump he wants the markets to do well, like ultimately, right?
Yeah.
Um, and yeah, it's what's he going to do then? Because like you said, if he doesn't do something drastic, if they can't find a way to juice it up, as you said, it's pretty effed, right?
Well,
Is there
they can
anything
try
he
and do like
can?
stimulus checks and stuff like this. You
Mm,
know, he's I think he already did the military guys for $1,700 or something like this. He can go down that route. He can try to bring rates down, but again, it all just happens to end up being the same stuff, which is they have to end up juicing the market to stay in. It's this, it's like someone trying to play a football game, and they're injured, they should come off, but
yeah,
they want to keep playing, so they keep injecting themselves for that energy boost or adrenaline boost to keep going, etc. And that's what the US like markets keeps doing, is keep
yeah,
injecting
for sure.
liquidity to keep it going. And really, that party has got to come to an end at some point. It won't happen anytime soon. It'll be
Yeah, for sure, for
years and
sure.
years away, but yeah.
Yeah. Look, I guess selfishly, we understand this is not good for the average person over time, and eventually this will crash in a sense, but we want the markets to do well. We're on this live stream because we hold Bitcoin, right? We want the
Yeah, yeah.
markets to do well. So we want them to juice it up, even if it's like, even if it's a market running on like energy drinks over actual food. What benefits us is the prices go boom, right?
Yeah.
So I guess it's going to be very, very interesting. Like you said, some of these stimulus checks could be interesting as well. Okay.
And
So
the average man struggling pushes them into markets because they have to gamble more. And I think that's why gambling sites have exploded, stock trading has exploded, crypto
mm,
trading has exploded. How many platforms now offer these like 0 day options? So it's all of that stuff is like blowing up big time because sort of people have realized, if I work a 9 to 5, I'm buggered basically. They almost, even the people that weren't willing historically to go and roll the dice to take that risk, those now younger kids are now saying I have no choice but to go and roll the dice. So they just go and roll the dice with options, stock options, crypto, prediction platforms, now betting, whatever. So in some ways it is good as well because it forces people or forces retail into our kind of markets where you'd like to think, well, we've got a better knowledge and know-how of navigating this market. And again, in the markets, there's not much value creation in the markets. It's sort of passing money
yeah.
between different people. For you to win, someone else has to lose. Usually, it's and so if you've got more retail coming into the markets, stocks, crypto, whatever it is, and you're more seasoned in the markets, same as playing poker. The same as that, really.
Yeah, no, it makes a lot of sense. I guess to, I guess almost summarize on Warsh, with the market crashing when he was nominated, was that because people assumed he was going to be hawkish and they
Yeah,
saw, yeah,
yeah. Sorry. So I didn't explain this. Walsh has historically been a hawk, and he's been a hawk at really bad times. So post GFC, post 2008, when unemployment rate was really moving higher, inflation was like 0.8% or 0.9%, and he was saying that the risk to inflation rising was greater
mhm,
than the risk to the unemployment rate rising. So the one time in history where you just did not want to be a hawk, he was a hawk. But again, you can't sit there and say, oh, because he was a hawk in 2009, he's going to be a hawk in 2026. Like, what do you think? He's not changed his opinion 15, 17 years later, whatever it is. So I think the market just looked at and said, Christ, this is a previously has been a very hawkish guy. He's going to be hawkish again, but Trump is not going to go and picked a guy that was going to be hawkish. So I think, and he's
exactly.
historically been an inflation hawk. So I think that was a big just overreaction and a misreaction or a bad reaction from the market.
Yeah, no, that makes sense. And circling back to yesterday's labor market data, uh, how how did it come in so unexpected? Like it was so off.
They updated the I think it's called the birth model or something like that. Again, there's other people I go to for inflation data that are like they're experts in that labor market data, and then I just try to whittle down about how these things interconnect to each other. But in terms of like working out like why it was such a stronger print, it's hard to really know. But again, they then revised jobs down for 2025, saying that the jobs that printed in 2025 were overestimated by 900,000. So it's
Oh,
like,
wow.
if you might have a print, say you get 130k, which is a really strong print in January, and you get that every month for the rest of the year, you've only got what 1.56 million jobs. If they then revise that down at the end of the year, saying we overestimated these 1.56 million jobs by 900,000, you can take 60% of the jobs back off the table. So it's ridiculous that the markets trade on it. I watch it because it's my job and it moves the market, so I have to watch it. But it's crap, like it's rubbish. Because they get revised down a month later, 2 months later, 3 months later, then a year later. So it's been constantly not revised down. Sorry, revised, but it's usually revised lower, which is the whole point. It's just all juiced.
Is it just to manipulate? And if it is really this relationship between inflation and interest rates and labor market, and they get numbers so wrong that they can justify a move, it seems a bit shady, to be honest. If you over-report job numbers being healthy, you can trick the average guy into thinking you're doing a good job, for example, right, in the economy, and it just gets revised, or vice versa. If you want an excuse to pump interest rates, and you say job market's not terrible, but it's going down, you almost can justify a rate cut when it's not warranted.
Yeah, so I mean, that's what Trump said about Powell before the election, because he cut by 50 basis points in the September, because the labor market data came out weaker. But again, the rate was at 5.5%. It did need to start coming down at that point. But yeah, we shouldn't be paying attention to it like we do, like not me, you, etc. But I mean, like everyone, all market participants should not be paying attention to this data as much. Really, the best people to speak to are the people on the street. Like if you go and speak to like normal people, if you're my example, my mom's a hairdresser. Like if I speak to her about how many clients she gets or has got, or are they cutting back, like those are usually really good indicators usually. And Druckenmiller himself, he goes to his local, he said he will canvass the streets a lot as well to work out if the job market is good or bad, or if people are hiring. More importantly, if people are spending. So he will go to his local mechanic for like tire changes and stuff like that, which I was like, so you go to a tire mechanic to get your tire changed. I don't know jack shit about this stuff, but you go and get your tire changed because something's gone wrong, not because you're trying to spend less. But he goes to people like that to sort of say, are people spending as much? Are your revenues down? Blah blah blah. Again, not to gain anything from them, but just to gain the information that the spending is slowing down, etc. So I think that's the best indicator or metric, is to go and speak to real people to work out, the people that run businesses that are consumer facing, for instance. I think that's the best metric.
That makes a lot of sense. And I guess speaking of data, we have inflation data coming tomorrow.
Yep.
So give us the update. What are the expectations, and why does it matter?
So I believe it's supposed to come in slightly higher. Essentially, it's going to show the year-on-year figures in the mid-twos. So it's essentially supposed to come in the mid-twos, like 2.6. But it's 2.6, 2.5 core and headline. That's year-on-year. But the month-on-month metric the month-on-month data point is supposed to tick up slightly. Anyway, so what the market is looking at the relationship between inflation and labor market, and if they can bring the Fed will now sit there and say, well, inflation is not at 2%. We still have tariff pass-through effects coming through, etc. So even though the labor market is showing some signs of weakening, you got a good print yesterday. So they'll say, okay, labor market is fine. Inflation is higher than our mandated 2% mandated target. So we're going to keep rates where we are. You even have some analysts or economists coming out and saying the next move will be a hike, but later in the year, if you get re-acceleration of the economy. Now, I don't think that will happen. And the sort of top economists, like you look at the Wallers, for instance, they're very concerned about the labor market. So, and I think the main thing to look at is not to look at the unemployment rate and the job, the payrolls, the, job losses, or it's supposed to be looking at the unemployment rate and the job losses. It's to be looking at the hiring rate. We've seen job openings come down considerably. So if employers are hiring much less, far less people, far fewer people, the chances are that that amount of hiring really comes in and keeps coming in, it's downtrending, so it's going to keep coming in, and then eventually it will kick in layoffs. And layoffs is the last thing to happen. It's the last thing to go. It's the last thing to move. So just because the unemployment rate is 4.4% now, 4.3, I can't even remember what it came in at. Yes, it came in 0.1% lower than it was previously. It all looks good on the surface. It all looks good, but you get layoffs. Layoffs is the last thing to go. So I think you want to be listening to people, and if they're very concerned about the labor market, then you should be as well. And the hiring rate is just very low. Like it's at COVID levels, the hiring rate. So I think that sort of says it all. So at this moment in time, the Fed think mid 2% inflation, we're not close to our 2% mandated target, and the labour market's fine. So we'll hold rates where they are. But if you start getting inflation trending lower or even staying still, it doesn't even have to go down, but the labour market starts to more materially weaken, you start to see layoffs, then they'll cut rates, and they'll be quick. They'll cut it aggressively. It won't be like a 25 basis points, skip a meeting, another 25. It'll be a series of 25, 25, 25. And if they think they're slightly behind, they'll do a 50 to start with. So again, the rate's at 3.5%, so there shouldn't be the need to go and do a 50 now. We're back in September of 24, that was at 5.5%, the interest rate, and the labour market was beginning to like show signs of deterioration, and they realised that 5.5% interest rate is very restrictive. So they were like, right out the gate, 50 basis points cut, and that just happened to be 2 months before the election, which is why another reason why Trump just doesn't like Powell, because he thought that was aiding the current administration, the Biden administration, or was going to be the Kamala Harris administration. So yeah, that's sort of where it is. So inflation is important. For instance, tomorrow, if you see inflation come in at 2.7, 2.8%, then the market will price cuts out more again. Again, it'll be very slightly. It'll be like 4 or 5 basis points, maybe even less. But again, that will send risk assets lower. If inflation comes in as forecasted, the market can just be range bound, because it's not really going to change the current status quo, which is we don't expect to cut now till June or July, probably now actually July. So tomorrow's print, the market will still watch it, but I don't think that it'll produce any real movement unless we see a meaningful downside surprise of like 2.2%. But no one's expecting that. So let's see.
No, that makes a lot of sense. And I think ultimately the long-term thesis for the rest of 2026, you just think rate cuts eventually kick in the second half of the year, and that's when the market starts to perform?
I think so. Again, we have to track it and see how it goes, but Warsh is not coming in to hold rates. So I think Warsh is coming in to get the rates back to neutral, which he'll say is 3% at most. He might argue for it being 2.5%, for instance, because he might say inflation is at 2.3% by the time he gets in. Neutral is at 3.3, for instance, or 2.8%. He might say it's 0.5% above inflation, which is at 2.3, call it 2.8. He might argue for 75 basis points of cuts from 3.5 to 2.75. So then you get 3 cuts just there. And you could argue for that, rather than that be some Stephen Moran type outlandish comment. You could actually make an argument for that. So I think that's the current basis, is he's going to come in, he's going to cut rates, especially if you see labour market weakness or inflation come lower. But if you see any form of labour market weakness, it'll be cut, and it won't be 1 or 2 cuts. It'll probably be 3 to 4.
That makes a lot of sense. Okay, I want to talk about a couple of other subjects with you. Is there anything from a macro lens you want to touch on before we move on to, let's say, on-chain?
We're watching Iran-US tensions, but I think Trump needs to make a move on this soon or just back off. But yeah, we're watching it, but we're not expecting anything anytime soon. I'm sure Trump will now bomb them this weekend or something, but now that I've said that. But yeah, that's the only other thing we watch. Obviously, we're watching things like the dollar against the yen, and because that can cause another unwind potentially, but that seems fine at this moment in time, seems contained at this moment in time. But other than that, it's basically just watching. I'm getting a good feeling at the moment from the just price action each day, in terms of like what I think. Not a good feeling because prices are doing crap, obviously, but a good feeling for like what's going to happen because of how prices are trading. Like Bitcoin is struggling to get bounces, which suggests there's not much risk appetite there. The Nasdaq has moved up into its moving average to then roll over, like if you look at the RSI and stuff like that, for instance, and now it's turning over. Yeah, crisis down 1.6% now. So again, it's like it's rolled over very slightly. So there's just this general feeling that it almost feels like there needs to be an excuse or a catalyst to send the market slower. Now, Bitcoin's already done a big move down, so can it go down? Yeah, I think it can go down. But I think if it produces a new low below 60k, I think that's a low for buying, and I think you want to really go for it, whether it be 58 or it be 52, whatever. I think you go for it, because then at that point it would have what we saw last time. And again, maybe I'm going on a tangent, but what we saw last time is that there's like options volatility. When Bitcoin came down to 60k before, there was massive buys in protection. So traders buying for protection. If you get a new low and it doesn't come with as much like fall, for instance, then that's probably a durable low. Where this current low, the 60k low, because it came with so much volatility and huge sort of put buying, for instance, people buying protection, that's not really what, you can get those lows in like COVID, but then you need the liquidity stimulus to form that V shape and go again. And we don't have that catalyst, that liquidity stimulus that's going to come in and cause the V shape. But we do have a market that can then come down and retest. So I think that's where Bitcoin is at this moment in time. And I think maybe it's the indexes, NASDAQ, S&P, etc., that roll over that then pushes Bitcoin down to 52 to 58, somewhere in that bracket. I think you then just want to sort of start going for it.
Yeah, that makes a lot of sense. Like you said, I don't think there are too many quote unquote positive catalysts to put things up, but I can absolutely see a couple of things putting it down. Could you give us some context on what's happening with MicroStrategy? Because from my understanding, they're trading below the Bitcoin value they have.
Yes, their MNAV is negative, I believe. Again, Aurora is the better person for this probably. I saw an interview with Saylor yesterday, and it just didn't look. He seemed far too like confident, and he said his liquidation price is like 8k, and then he would just refinance the debt. But the interviewer was like, who's going to refinance you, sort of thing, and he was like, we'll just refinance. It was not good, but Bitcoin's not going to 8k, so he'll probably be fine. But it's I don't know how much of a positive impact. He needs to now take the lead on quantum. That's what his job needs to be. Rather than sit back and chill out, he needs to take the lead on quantum to getting the Bitcoin network as a whole more quantum proof, because I think that's what my personal opinion. Again, it's my opinion. I believe that's what's keeping big money on the sides and people risking off. And if you think 60k, like 4 months ago, if you thought 70k was attractive, I think deduct that by 10-15%. So you're at 60k. If price now comes to 60k, for instance, I think take 10% off that again, because I think there's just with that added quantum threat, is Bitcoin going to go back to 120k because with this quantum threat still hanging over it? Probably not. I think that needs. So don't be wrong. If Bitcoin comes down to 50k, you wouldn't be buying it with the view that in 6, 9, 12 months time the quantum threat will be solved and you've got all your catalysts by then. But obviously, price is not good. Price is going to have bottomed in a couple of months time at 50k. You don't want to be buying it when the quantum thing is solved in 6, 12, whatever months time. Price would have already bottomed by then.
No, absolutely, that makes sense. It's really interesting. I guess it kind of makes everyone question the whole treasury strategy, of holding Bitcoin in their treasury, trying to follow the MicroStrategy playbook, because look at their position, right? It's not exactly working. And the quantum threat, we've discussed it a couple of times. I think perhaps in reality, it's overblown, but it's a narrative. And if that's what people are talking about, you got to listen. The people who keep coming to me and talking about the quantum threat are my friends who don't really get crypto. And you said keep your ear close to the street, and that's what you mentioned. Your mother is a hairdresser. I've had a lot of people, and it might sound funny to people watching, come and tell me over the last week that it was Epstein behind Bitcoin. You probably have seen this too, which I think in some senses you can argue is a bottom signal when the normie is coming up and telling you this. But I guess from a more practical, realistic point of view, can we talk about the miners and the level at which they're no longer profitable? Because I think with AI, there's been so many, I believe energy costs have increased, and that's only going to continue further. So what's the score with the Bitcoin miners? How are we going to keep them incentivized if Bitcoin keeps dropping and electricity keeps going up?
So they won't stay incentivized. Trying to bring up the chart. It's very slow getting my stuff up whilst I'm on the stream. But if price drops to a certain level, they'll just turn off, and the network will basically will barely run anymore. So at the moment, where are we at? So I did that update the other week where I put in. I think I'm stalling a little bit because I'm just getting this loaded in the background. I did that update the other week where I showed the electrical cost and the production cost. So now the miner price is 67K, which is usually it's if you can buy the miner price, or in the bear markets, if you can buy below the miner price, it's usually a good time to buy. Like historically, you do quite well. If you can buy the electrical cost price, which I think you was only given in COVID. You was only given in COVID. I think it touched it in 2019 as well, the end of 2018. Yeah. But that current price, it was very close in FTX Blub. It's very close. I think the miner price at the time was 14.9 and the price went to 15.8. So it was very close then. The electrical cost today is 50,800. But again, this is a trending down indicator. So when I looked at it the other day, it was 51,700, something like this. And the production cost is currently 63,500, which is why that's the top of our buying zone. And again, electric cost is at 50. You have realized price at 56. You have the weekly moving average, I believe, at 50, or the 200 week moving average at 58. And you then it was the electrical cost was 51,700. It's now 50,800. So you have a ton of key on-chain levels between sort of 50 and 63. The closer you can get to the 50 mark rather than the 63 mark, the better. But that's why we're having that targeted. Price did wick into the production cost. Obviously, it was 63K. It is 63K, and it went to 60K. So if you can get more fills of that band between 63K and 50K, that's like your long-term area to be buying. And I think if we can get the indexes rolling over, for instance, that's what could sort of plunge Bitcoin into a new low. And I think you just got to be pretty much, I don't know if it's a kitchen sink moment, but it's a get in with some size at that moment in time. And if it lingers there and it pulls back to sort of 50, 51, 52, that's a kitchen sink.
That makes a lot of sense. And I think that's the overarching strategy you've been talking about as of late, like risking off and then putting in ladder buys all the way down between, I guess, those two levels. So that makes a lot of sense. If someone's sitting here now and they are open to quote unquote trading Bitcoin, so they're still long-term holders, they don't mind holding the asset, but perhaps they're thinking, you know what, if I can get a little extra Bitcoin for my Bitcoin, would you recommend that for most people that approach? And what key levels from this moment, if you were to pull out now and start buying in?
No, I wouldn't recommend it. Like I do it. I do this 24/7, and I find it very, very difficult. I think in my spot bags personally, in the last, I haven't made money since October. I've been tracking my performance very, very strongly since October 10th. In my spot bags, the rest of October and November, I was profitable. December and January, I think I'm down, but it's nothing. But then in my futures trading, I'm up over the whole period. So I've done well over the whole period. But I've had to really grind it out. Like it's been a real job's worth. And I would say I'm pretty good at the market, and I find it very difficult. So I think I think the way I would describe it is, there's me and other people like me, and I'm not like a phenomenon or anything like that. That's not what I'm saying. But you'll be competing against people like me that sat here 24/7. So if you can't at least match me on that, or you've got to be sort of much more intelligent than me or whatever. Again, not to say that I'm hugely intelligent or anything like this, but if you're running a business or you're running a job, I would not go for the trading, because it's just, you're competing against essentially people that are just spending more time on it, learning on it more, becoming better at it, where you can't outcompete those people. You're best off sticking with the, even the swing trading strategies is fine on a sort of like play. If Bitcoin came into like the 72 to 66 area. You could sell a bit for then to move back down to 63, 66 even, even looking at it like that. But again, is it really worth the juice it squeezes, for instance? It might not be worth it. No, I would always say, especially in this period, when you're in a bull market and there's big volumes everywhere, then all of a sudden there's new opportunities like cropping up all the time. When you're in like a much more bearish period, volumes are lower. There's, for instance, like other categories are not popping off anymore like they were popping off 6 months ago, a year ago, etc. So you're just in this more of a lull period, and you're more susceptible to be chopped up in that period. So really, you're better off not doing a lot. If anything, the one thing I would advocate for is the yield farming stuff. Like I've started when Sol was 200, the yield farming, I'm not sure is the strategy, because you don't carry enough upside potential and you carry too much of the downside. For instance, if price comes down a lot, you lose a lot. But if price goes up to the top of your range, you only make 50% of what, say you was holding a spot trade in it, you'd only make 50% of that profit. But you get paid the yield each day, obviously. Now when prices are lower, like Sol is at 78, for instance, now, if you can go and get yield farming strategy at $70, $60, if Sol goes to $50, I mean, I don't think you do yield farming at $50. I think you just buy it. You just buy it and hold it. But say between 60 and 90, you've got a yield farming strategy. If price goes up, you'll make more money, but you might be out of your position quicker. But again, you'll still make money. If price rolls over and goes down, you'll just be increasing your exposure to Sol at lower prices. And for us to longer term believers, we don't care about that. We will take the yield whilst we're filling more of the position, if that makes sense. So absolutely. I think that's a good strategy for someone now, for instance, to get more exposure and to be earning passively in the meantime as well. But again, I would allocate, say you want to get a position to Sol, I would allocate now at 78, do another one at say 68, do another one at say 58, and just do it like that. Reassess it 6 weeks down the line, another 6 weeks down the line, because you might have a chance to get, if you can get prices 10, 15% lower, do it on that day, even if it's tomorrow or in 4 weeks' time, whatever it ends up being, do it on those days, because all of a sudden your spot buy is lower for when you input to the pool.
Yeah, no, it makes a lot of sense. We just did a YouTube video on CLPs. Yeah. It's like 45 minutes long. It covers everything you need to know. That's really cool. You've mentioned some key levels for Bitcoin. I do want to touch on, I'll touch on this subject first, actually. So you kind of shared the playbook for how the average guy should approach the market right now, and what you're looking at and what you're sharing with the people watching this. How are institutions looking at this? How are the ETF buyers looking at this? Because outflows have been higher as of late, but they don't trade it like a normal person. They have quota standards, etc. So how are they looking at this right now?
So they are, I saw an analysis the other day, again, someone that analyzes the ETF flows, and you get big inflows and you get big outflows. We've had a lot of big outflows, but mostly the ETF guys are hodlers. Even though you have days of big outflows, most of them are hodlers. So I think the ETFs are not the problem. The problem that we've had is the long-term holders, which were selling down in a big chunk. They then eased up considerably. They're now selling down in a big chunk again, which is obviously not attractive when prices bounce from. It's like they've capped price at 70k basically. So I think that's still a problem. Don't get me wrong, because they might be sitting there thinking like, Christ, I've sort of cocked this up, etc. The game plan was to be in at $500 and sell it at 100k and sell into the institutions, sell into ETFs, etc. And that's all played out. That narrative has absolutely happened and played out. And you're seeing this long sort of long drawn out process of changing hands, which is from, this is now a new asset. I think Bitcoin is 1 trillion market cap and gold is like 54 or something. Is that right? Or is two? The spread now is massive. It used to be like 7x the size. It's now those numbers aren't correct. So someone will quote me on them, but don't quote me on them. But the spread is now huge. So essentially the long-term thesis for those long-term holders has played out. And I think now what they would have been gunning for has been greedy and gunned for 150k. It's not happened. Prices rolled over. They thought, I'll wait for a bounce. Not really got it at any point. and now they're thinking, Christ, just get me out to 70. I'll take 7/10 of that, for instance. And I think you're just seeing this changing of the guard from these long-term holders that were these sort of, buy this thing at $500. We believe in this sort of crazy movement or whatever, sell it into the institutions. Now the institutions are saying, okay, this is now a big enough asset that we can start getting involved in, and they'll start buying up for the long term. And that's why I think if you get a sort of a path to a solution for the quantum thing, because I think even though it might not be as big a threat as what some people might think, big money will just sit there and go, that all that supply could come back online. Oh, no thanks, mate, I'll leave it. And really, if you said, oh no, but the odds are actually this, they'd go, no, I'll leave it. So even though they might be overpricing it massively, but again, just the removal of that, I think the removal of that is the next narrative that takes prices back to all-time highs and things like that. Because then I think people will say, oh, it's been through another bear market. It's, gold has had its turn. Now it's Bitcoin's turn. The quantum threat is solved. You're going to see this old money move into, as the grandparents die, the kids are going to get the money and they're going to want Bitcoin, not gold, blah, blah, blah. And you're going to start to see that movement. I think that's going to be the next narrative for Bitcoin. And then other things in the ecosystems will spring out, whether it's hyperliquid, Sol, whatever. That's why I think we're out of this, but I don't think that's a 2-year bear market process. I think the bear markets are just much smaller. It's similar to equities, I think.
No, it makes a lot of sense. I agree. Still keep getting messages about if we think we're wrong, we changed our mind on the 4-year cycle. Just gonna have to see the market move up for people to relax.
Yeah, and I think the 4-year cycle, you can say we're wrong on the 4-year cycle. There's too many 4-year cycle believers that have sold, but the 4-year cycle was based off of the mining, the halving and all that. The halving, the supply that comes online now, is at the smallest fraction of the total sell pressure and volume each day. That it's not impactful at all. So that was the old cycles, and the 4-year cycles were based off of that. So if in that sense, that's not a thing anymore. But the 4-year cycles, there's too many believers in this 4-year cycle, so that's potentially why that's playing out. So yeah, at the moment, I'm the one that's been the big advocate of that, so I'm the one that looks, I suppose, like the biggest idiot. But I still think I'm right, because again, it's to do with the halving. It's not to do with
absolutely.
But I get it. People say, "Well, price has gone down in the 4th year." I was be like, "Well, yeah, you're right, mate." And that's it.
No, I think it's easy, right? It's easy to look for. You can see faces when you look at the clouds. Sometimes you see faces just out of flipping clouds, and it's easy to find coincidences. And I think in this case, it's more of a coincidence. The game just changed. You've got institutional players now. They're not playing the game the same as the miners. It's a different approach. So yeah, I definitely think it's over in that sense. We mentioned some key levels for Bitcoin and Ethereum a little bit. Let's touch on ETH as well. We touched on Sol, we touched on Bitcoin. Let's talk ETH for a second, because ETH's in that interesting spot where no one's talking about a quantum threat for ETH. Institutions have adopted it. There's a lot of regulatory clarity on the table. As a infrastructure product, because it's a lot cheaper now, right? The fees aren't insane, so it's they're not exactly monetizing too much, but yeah, it's almost in this weird line between the likes of a Bitcoin and the rest of the crypto market. So what's Ethereum looking like right now from your perspective? And do you monitor the flows for that too?
No, not particularly. I think it's all driven by Bitcoin. So if Bitcoin goes up, most of the other stuff should go up. Again, it hasn't been in recent years, but if Bitcoin goes up, ETH will mostly go up. Obviously, ETH this time, I think, was driven by Tom Lee mostly. But I think this belongs back at 1,1600, and I think then you can start getting interested again. But if Sol went to 55 or ETH went to 1,500, what would you put your money on?
Me personally?
Yeah.
Both, to be honest with you. I think they're very different.
Yeah, I know what you mean. I think I prefer Sol, but I think ETH is the one. For instance, if I was going to stake my money, I would stake it on ETH absolutely over Sol. But in terms of upside for the actual coin, but then maybe the ecosystem might be better for ETH in the next year or two years rather than Sol.
Yeah, look, I'll give you my take because obviously before this live stream, I spoke to a few people just to kind of plan and discuss what topics to come up with. And one of them was the 4 year cycle. And I was speaking to a guy who's very clever and he's in a position where he felt like he needs to risk off a lot. He's one of the smarter people I know. And when talking to him, the theses he had 6 weeks ago, um, none of the fundamentals changed for his theses, but the market pressure has thrown him out of whack. And now he's
Yeah,
starting to consider the 4 year cycle, or questioning the actual value accrual of an Ethereum and Solana. And when I'm talking to him, he's a very clever guy. I'm like, you're questioning everything you said 6 weeks ago, but nothing fundamentally changed. And he acknowledged that. He goes, yeah, it's just the emotions of the market. And even the people kind of leaning into the quantum threat, or like you said, it's based off miners.
yeah,
What they're missing is, look, if you just zoom out, you've been saying this for a while, and crypto as a whole has been saying it. It's just macro conditions.
yeah,
Ultimately, big money is not in a position that it really wants to go risk on right now. Right? That's the reality. So I don't think personally these macro guys, these huge like hedge funds and institutions, they're sitting there thinking, you know what? I'm not going to buy any Bitcoin right now because of this 4 year cycle narrative. That's not the
no, yeah, no
reason.
way.
It's happenstance. That's
Yeah,
not the reason they're not buying in, right? They're not avoiding, I think, Ethereum because they're like, oh no, Solana's an Ethereum killer. Right? They're not thinking
yeah,
it
yeah,
like that. For them, it's just broader conditions. And I look across the board and I think when it comes to something like Ethereum, we're at sub 2K, Solana $80. Unless something goes super wrong, when we risk on, personally, I don't know how these things don't run very intensely, all of them. And you can almost look at them from a market cap size perspective. Yeah, Solar's more upside. It's a lot smaller, right? Hyperliquid has more upside. It's a lot smaller. So for me, I think all of these things are going to perform. I think we just have to get to the second half of the year and not get tapped out before that. So yeah,
yeah. No, I agree. I think again, if I was going to stake money, it'd be on ETH absolutely. And I think if Vitalik could do something and move away from L2s and push ETH in a
he
slightly,
did.
yeah,
He
I
made some
think,
comments. Yeah.
yeah, I think if he can like start taking the reins a bit more again and push this, I mean, he's a strange bloke, but if he can start taking the reins and pushing that again properly, I think the next, I don't know about cycle, but the next sort of cycle could be on ETH rather than Sol. But again, I think you own all of them, like Bitcoin, ETH, Sol, Hype, like those majors. Again, like Hype is just one of those ones. I just can't seem to get the buying of that coin correct. Like it's just the one. Like Sol, I feel good trading. ETH, I feel okay, but Bitcoin, I feel good trading. Sol, I feel good trading. Hype, I've just never been able to. It's the chart feels strange to me. It goes up at times when nothing else goes up. It goes down when other things don't go down. It's just strange. It's just a strange coin. So
Yeah.
I think that's one of those ones where I was saying to Assad like a while ago, um, is what if that goes to like $16 to $24, I'll just clip in a small amount each time, whatever I can afford, to put in a tiny amount and forget about. And then I'll check back in a few days' time. If it's gone down 4%, I'll put another bit of that in again and just build a position over
Yeah.
time and then just pray that my position doesn't get above like 40% or something.
Yeah. I think with Hype and Hyperliquid, it's different because they obviously have a lot of buybacks. Like
Yeah.
their financial model, it's different to most tokens. And at the same time, because of the token unlocks that seem to come sporadically, they're not sporadic. You know what I mean? For an
Yeah.
average
Yeah.
holder, they're like,
Yeah.
when's it going to come? When's it going to come? So it's a little different, these kind of revenue generating protocols. Whereas when you look at Ethereum and Solana and these things, they're not based off revenue. They're based off like infrastructure. One of
Yeah.
the interesting things I spoke to a brewer about is when you look at Solana and Ethereum and you compare it to the likes of a Hyperliquid, their goal is not to generate as much fees as possible. Solana could 10x the amount of fees it charges, and retail wouldn't notice. That's how cheap it is,
Yeah.
right? But a broad theory, and I agree with it, is maybe in the short term, it means the likes of Ethereum and Solana, because they're so cheap now and they're not focusing on revenue, they will underperform something like Bitcoin because of narrative and underperform Hyperliquid because they're not focusing on bringing that cash in.
Yeah.
But they will take up so much market share that at a certain point they can just ramp the fees up and you're kind of stuck. All
Yeah.
the interesting apps are in Ethereum and Solana. And it's like you've wiped everyone out. You've made your products so good, so affordable for so long that at any particular point, you can choose to become the dominant player by upping your fees. What are you going to do? You're going to leave? Imagine you're an application layer built on like Solana, right? You're an app built on Solana and you're doing great for so long and you're so cheap and all your users are there. And then suddenly Solana comes in and puts a fat fee on you. What are you going to do? You're going to leave? It's not going to happen.
Yeah.
So I think it's almost like a multi-cycle thing where maybe right now Ethereum and Solana really focus on bringing the users and building the infrastructure out. And then at the drop of a hat, they can really switch on the money-making machine if they want to.
Yeah, I think that makes a lot of sense as well, and that's what happened in 2021. Ethereum was doing all the NFTs, and the gas fees were insane. They were literally insane. Like I remember doing Ethereum NFTs and paying like $400, $600 in gas, and you would think, yeah, I'll make $4,000 off flipping this NFT, or something like this. So, but it was just absolutely mental. And Sol basically sort of came around more in that because they started doing the NFTs. I can't remember some of the names. I think literally all of them went to zero. But I think it was just like the cheaper one, and people were then going on and really trying to sort of scalp stuff and whatnot. And Sol sort of became, I think that ecosystem became, in terms of getting the users, became more prominent because they were doing NFTs and it was cheap. The gas fees were cheap.
Yeah, absolutely. And I think that's what they're going to focus on: efficiency, affordability, they'll bring the users in, and then they will offer solutions that they can charge a lot more for, in my opinion. And it's interesting when you look at something like Hyperliquid, and it's almost working in reverse. They have great products, it's revenue generating, but they're almost taking every other project they can see in the DeFi space and saying, how can we do a better job? Right? Bringing on prediction markets, perps, etc., vaults. So it's very interesting. I think, Tom, from a macro perspective, and what we already went over ETFs, and I guess some of these fundamentals, we've covered a lot of bases. Are there any other key topics you think are important we cover?
I don't think so. I think for most people, just be patient. I think you get paid to pull the trigger at the right time, and I think don't let yourself. I think when you look at the prior markets, the big moves down, the first 50% is sort of the easy part. The second bit, is it going to be a 60% pullback, a 70% pullback, whatever? That next bit, don't let yourself get chopped up, because that can be, rather than from all-time highs down 50% is usually comes straight down. The next 10-20% is very difficult. Don't let yourself get chopped up in that bit. And when you get to extremes, either in sentiment, it can be, yeah, I'd say mostly things like sentiment indicators, whatever. When you get to extreme lows, extreme fear, extreme oversold, whatever, start chipping in those. And like we obviously try to give over key cost basis levels, on-chain levels, show the sort of flows, provide with that range of where to sort of stack or ladder orders for buys. So just remain patient. Don't get chopped up in this, like what can be like the difficult part. It will seem like the difficult part, but if you actually take a step back and sit out, it's sort of an easier part. Or can be an easier part if you make it an easier part. So that's what I say. I would just advocate for a bit of patience and to sort of treat it a little bit as if your money doesn't mean anything to you. And if you see it go down 10%, don't worry about it too much, because buying that bottoming process is a process. So build a position.
Yeah, absolutely. Look, that's where the opportunity is, right? If we went back 6 months or even, hey, a year and a half ago, in fairness of some of these assets, you would have died for these prices. So, of
Yeah.
course, if you have no cash, I understand the stress, but if you have capital, absolutely deploy in a smart way. Don't just go balls to the wall. But this is where the opportunity is made, right? Money's made when you buy, not when you sell. So, yeah, I think people just need to relax a little bit. I understand it's a difficult market, but I think you got to control your emotions. And of course, look, Tom, tomorrow you guys are producing the market direction. Bitcoin, Ethereum, Solana, Hype, meme coins, doing the market direction a couple of times a week. You've got your weekly setup on Monday. And I think like the pro members, they're covered, right? They just need to read all of these updates and not act irrationally. And of course, for the more one-to-one stuff, like we're talking to people now directly with the inner circle stuff. So I think everything would be cool. I think the people who have been around longer and have more capital are actually a lot calmer than the people with smaller bags. So yeah, I
Yeah.
would say everyone just relax a little bit.
Yeah. Agreed.
Yeah, amazing. Tom, thank you very much. Appreciate it.
Thank
Take
you,
it
mate.
easy.
You
And
too.
yeah, I think we can go offline from here. See you guys. Second.